Welcome to Bite Size Tech, where we like to take a deep dive into all things tech and gadgets. I'm your host, and with me today is our amazing expert, ready to get into it.
Always. We've got a lot to cover today, from potential shifts in crypto regulation, the massive funding round for OpenAI, to considerations for investment in these volatile markets. Oh, and we can't forget the impact of these new auto tariffs.
Yeah, that's a lot to unpack. So let's jump right in with the wild world of crypto regulation. There are murmurs that the U.S. might be moving away from this regulation by enforcement approach. What do you make of that?
Well, it's interesting you say that because the recent nomination hearing for Paul Atkins really highlights this potential shift. You see, Senator Warren expressed some concerns.
I bet she did.
Yeah, she kind of hinted that Atkins might create a looser regulatory environment. But then you have people like Aya Kantorovich. You know her.
CEO of August, right?
That's the one. She actually argues that Atkins is pretty tough on market manipulation and fraud. He's a big proponent of KYC and AML, know your customer, and anti-money laundering. He seems to want clear regulations that could actually encourage crypto companies to operate in the U.S.
So kind of the opposite of what Warren's suggesting. Interesting. And didn't he also divest from all his crypto holdings?
Exactly. To avoid any conflict of interest. It makes you think, though, right? To effectively regulate something as new and complex as crypto, do you want someone who's already deeply familiar with it, or a traditional regulatory figure?
Right. Like, do you want a mechanic who knows every inch of the engine or a seasoned engineer overseeing the whole operation?
It's a tough one. There are pros and cons to both. But speaking of regulation shifts, we're actually seeing the Biden administration walk back on some existing crypto regulations, specifically the IRS broker-dealer rule and the 1099 filing requirement for decentralized exchanges.
Yeah, that always seemed like a bit of a square peg in a round hole, right? Applying traditional brokerage rules to these decentralized platforms.
Exactly. Trying to track individual users on these anonymous platforms, it just didn't fit.
But it's not all backward steps. There's some progress, too, like FIT 21, the stablecoin regulation bill making its way through Congress, and Wyoming's plan to launch its own stablecoin.
I read that Aya Kantorovich thinks we've seen more progress on crypto regulation in the last 4 months than in the past 4 years.
Wow. That's a bold statement, but maybe not far off the mark. It echoes what Paul Atkins has been saying about regulatory uncertainty hindering capital formation. His goal, he says, is to bring some common sense back to the SEC.
Easier said than done, I suppose, but what would that look like?
Well, ideally, it means creating regulations that are clear and foster innovation without compromising consumer protection. He has a point, though, when he says the U.S. is lagging behind. Look at Europe with MiCA, their markets and crypto assets framework, and Singapore with their MRs, Monetary Authority of Singapore regulations. Both are way ahead in terms of comprehensive crypto rules. Right, so it's not just about weeding out bad actors. It's about creating a framework that allows legitimate crypto businesses to thrive and, choose the U.S. as their base. Which brings us to the question of token foundations. Right now, a lot of them end up being established offshore.
Yeah, in places like the British Virgin Islands or the Cayman Islands. It's a bit of a brain drain. But Aya Kantorovich argues that if the U.S. had clear guidelines for launching these foundations domestically, we'd see greater transparency. Think about it. Readily available tax filings, audits, all good for investors.
Absolutely. Okay, enough about crypto for now. Let's talk about something else that's been blowing my mind. OpenAI. They're reportedly closing in on a $40 billion funding round led by SoftBank. That's just, wow.
$40 billion. It's the biggest funding round ever. And it just shows the immense faith investors have in OpenAI's potential, their constant stream of new releases like that image generator, and their ambitious revenue projections. I mean, they're expecting to triple their revenue this year.
I can't even imagine the kind of expenses they must have. I mean, the talent, the data centers, those crazy expensive AI chips.
Oh, the operational cost must be astronomical, absolutely.
Yeah.
But it's interesting to look at the diversity of their investors. You've got hedge funds like Magnetar, Altimeter, Coatue, alongside traditional venture capitalists and sovereign wealth funds from all over the world.
So it really does seem like they're being positioned as the next trillion-dollar company, like Google or Meta.
That's the bet. And for SoftBank, it's a big step in their goal of becoming a leader in the development of AGI, artificial general intelligence. They want to be at the forefront of that race.
But with this huge influx of private capital, does that mean an IPO is off the table for now?
It's hard to say. This funding does give them a lot of breathing room, but ultimately the decision to go public will depend on a lot of factors. Market conditions, their growth trajectory, it's still up in the air.
Okay. So let's shift gears and talk about the elephant in the room, market volatility. Things are pretty uncertain right now, especially with trade policy hanging in the balance. Are investors still willing to take risks in this climate?
Well, people are definitely watching those sentiment indicators very closely. There's this idea of contrarian investing, right? Becoming bullish when everyone else is bearish,
Yeah.
hoping to catch that upswing. We're seeing hints of that, but it's not a stampede yet.
So, cautious optimism in certain areas. What's the advice for investors trying to navigate these choppy waters?
Active portfolio rebalancing is key, especially if your tech holdings have taken a hit. Tech has really borne the brunt of the recent downturn.
Makes sense given how high valuations had climbed, but I'm guessing there's also a warning against trying to perfectly time the market.
Yeah, you don't want to be catching a falling knife, as they say.
Yeah.
Remember the dot-com bubble. It's not always a straight bounce back up. And this trade uncertainty adds another layer of complexity. While the initial tariffs have targeted sectors like automobiles, there's always the risk of retaliation, which would hit the tech industry hard.
Right, because trade uncertainty isn't confined to physical goods. It casts a shadow over the digital economy, too. And didn't I hear something about April 2nd? Some potential clarification on the tariff situation?
That's the date everyone's watching. Until then, it's tough to go all in on tech stocks. We might even see CEOs lowering their earnings guidance in the next earnings season, just because of the uncertainty.
It's understandable. It's hard to make accurate forecasts when you don't know what the trade landscape will look like. And the uncertainty itself can be damaging.
It's like a headwind, right? Businesses become hesitant to invest, to hire. They pull back on capital expenditures. And then, on the fixed income side, a diversified bond portfolio can offer some stability. Treasuries, maybe some corporate bonds. It all depends on your risk tolerance and what you're aiming for.
Okay, let's wrap up with those auto tariffs. Trump signed off on that 25% tariff on imported cars. What's the fallout so far?
Well, it's already having a ripple effect. Sales are down, automaker stocks are taking a hit. Even the tier one suppliers, the ones making the parts, are feeling the squeeze. And while bringing supply chains back home sounds good in theory, automakers have spent decades building these intricate global networks.
It's not as simple as packing up and moving everything back, right? So what options do automakers have?
It's a tough spot. Andrew Rogers, he's a government affairs expert, says they're facing three choices: absorb the costs and see their profits shrink, pass the costs on to consumers with higher prices, or try to reshore manufacturing. But that last one's a huge gamble. Why make those long-term investments if the tariffs might disappear in a few years?
Right. The auto industry needs some predictability for those kinds of decisions. These tariffs just throw a wrench in the works, especially when you consider the EV sector, which had been getting clear signals through initiatives like the Bipartisan Infrastructure Law, the Inflation Reduction Act, and the CFTS Act.
This is a complete contrast. Those initiatives were all about encouraging investment in EVs. These tariffs feel more reactive than strategic.
It's interesting, though, that the market seems to think Tesla and Rivian are somewhat insulated from this.
Yeah, and that's because Tesla manufactures all their U.S. vehicles here in California and Texas. And Rivian has a real focus on owning their supply chain, so they're not as exposed to imported vehicles and parts as, say, Ford or GM, who rely heavily on places like Mexico and Canada.
But even if some companies are better positioned, the overall expectation is still that car prices will go up, right? Especially for EVs.
Absolutely. Estimates range from $5,000 to $8,000 for the average car. For EVs, it could be closer to $12,000 because of those imported battery components and rare earth minerals. It's a complicated supply chain.
So the goal might be to boost domestic auto manufacturing, but the immediate impact could be higher costs for consumers and disruptions to an industry already grappling with this huge transition to EVs. What's the big question everyone in the industry is asking about these tariffs?
Andrew Rogers says it's pretty simple. Is this real? Are these tariffs here to stay? Is this the new normal they need to plan for? They need that clarity to make informed decisions.
And on a related note, there are reports that funding's been cut for the agency that handles chip export controls. Seems a little counterintuitive given the emphasis on U.S. tech leadership.
It is. The Trump administration's decision to cut funding for that Commerce Department agency has raised some eyebrows. Some worry it could hinder our efforts to stay ahead of China in the AI race, and it might even have national security implications. It's definitely a head-scratcher.
Well, I think we've covered a lot of ground today. We've gone from potential shifts in crypto regulation to the huge bets on OpenAI, from navigating market volatility to the impact of auto tariffs. A lot to think about.
Absolutely. And it's all connected, right? How crypto regulation could make or break innovation. How the money flowing into OpenAI shows the belief in transformative tech. how market volatility creates both risk and opportunity, and how trade policies can reshape entire industries, like we're seeing with the auto sector.
It's a wild, exciting, and sometimes a little scary time to be following tech. So, with all these developments happening at once, what do you think will have the biggest impact on the tech world in the long run? And how do you think it'll change how we understand technology?
Thanks for joining us for this deep dive here on Bite Size Tech. If you enjoyed the episode, hit that like button, leave us a comment, share it with your friends, and subscribe for more fun tech discussions.
See you next time.
Bye for now.